Hello viewers and welcome back. You're watching Ducoscopy TV with me, Natalie MacDonald. Joining me now in the studio is Dr. Hank Pruden. Hank, thank you so much for coming in today.
Natalie, I'm delighted to be with you here today in Geneva.
You're very, very welcome. Now, Hank, I wanted to ask you, how were you first attracted to the Wyckoff Method? And in fact, before that, would you mind explaining the methodology to our viewers who may not be so familiar?
Okay, the methodology is a pretty straightforward bar chart, price and volume over time methodology. Its companion piece is a point and figure chart. And a point and figure charts have a special role to play in the Wyckoff Method. And so one starts out with a bar chart and reflected in the phases of a market cycle, either in shorter term, or I like to study it more, say, in the business cycle context. And what we have during the previous bear market, ending with selling panic, people wishing to get other securities, and we always have to keep in mind, and Wyckoff very strongly emphasized, it's an exchange phenomenon. There's always a matching of buyers and sellers. So oftentimes our bars that we see on charts make it as if it's a singular phenomenon occurring. The prices and volume are such. But if we break it into pieces, then we have two parties. There are always two general parties of buyers and sellers. At the bottom, during the accumulation, we can generalize that during the good deal of fear existing in the market, there is a smart money, deep pockets, capacity buyer. And Mr. Wyckoff characterized an individual whom we call the composite operator or the composite man. That grew out of the old pool operations which existed in the early parts of the 1900s prior to the Securities and Exchange Commission. So the pool operator then would accumulate the securities over a period of time, holding them within the trading range and buying on balance. When he completed his accumulation of inventory and there was no more or less a floating supply, which means price of stock floating into the market, then he would engage into or encourage a markup, which is then, he said, keep in mind, it's like a merchandising business. You buy stock when it's low and you sell stock when it's high priced. And there's a markup in price between the bottom and the top. That markup is accomplished with the aid of people who are attracted into the market, following the composite man who will lend his support over price, over time. And we can see that reflected in periods even of re-accumulation. And then ultimately, the final stages is when we attract the general public in, as you would into a retail store, and say, this is then now, they will be excited to come in, and this is unfortunately usually at the top of the market. So that's when the prices are the highest. And then we'll engage in, again, a sort of a retail term, distribution. We distribute the large holdings into piecemeal fashion to the late arriving general public. And to keep the prices upward in a trading range called distribution, and the support of that trading range being lended to or by the smart money composite operator and his allies, until we see exhaustion. There's simply no more buyers left, at which time then the smart money composite man and its follower would reverse efforts, pull their supports, encourage prices to drop, and then engage in the markdown phase, which is our characterized bear market. And that typically happens in a swooning of prices and bad news and fear occurring. And that's the completing phase until we come down to climactic activity near the end of it. And then we have the laggards coming into the market who had hesitated to enter in at first, are hanging on their securities, and then either through fear or distress, give them up at the bottom. This is the other cycle.
I wanted to put this thinking into practice a little bit. If we take a look, then we've got the Dow Jones Industrial Average here. How would you use this methodology then for, say, market outlook on the Dow Jones?
Okay, excellent question. And here we go to the other chart type of approach. I mentioned the bar chart, which was expressed in the former graph. Now we're turning to the point and figure chart. use a figure chart. It's price only. It, as you can see, there are boxes here. The boxes are going up and down, and we select a particular price interval to construct a box. And this happens to be at a convenience because it's Dow Jones Industrial Average, and we're up in the thousands on the Dow Jones Industrial Average. So these are each box represents 100 points of Dow Jones price action, and this is what is a standard that's used in the industry, a 3-box reversal chart. Now here's an incredible thing that I discovered, Natalie, and I am skeptical about it, is that there's actually a quantification that can be made over a trading range as the security moves sideways that would then later on give you a potential to anticipate the probable extent of its future movement. In other words, a base would be built that would give you a count across the base, which you can then project upward in giving a price estimation about where a price would go. Take, for example, the last distressed market we had, and this was the 2008, 2009, starting with the Lehman Brothers collapse in 2008, a shakeout in 2009. And then we had a strong rally out of that. That rally characterized that finally we had a sign of strength. And the pullback after the sign of strength, which is tested it to make sure that it is a sign of strength and not a false rally, we'll call the last point of support. At that juncture, recognizing that on the bar chart, one turns to the point and figure chart as a companion piece to measure the extent of that accumulation. So using the extent of counting the number of columns and the values by each is simply an arithmetic calculation of how many points have been accumulated. And at the 8,100 level in the year 2009, about probably around May or April, we had a base built that would give us upside potential on the Dow Jones Industrial Average to mark up to rather distinguish 17,600 to 19,200. So said the charts. So that would be the Wyckoff Method, and it's under the law of cause and effect used by Wyckoff. So there's a law of supply and demand on the bar chart, a law of cause and effect with a point and figure chart. There's two companion approaches. So one would say, we've got the basis for a good bull market, should then evolve into an uptrending market. And if one has total confidence in this, you say, okay, this would be a great juncture at which to purchase. This gives you a reward to risk idea. We could set stops below the supports. And if you had a rule that I want 3 or 1 or better, a potential reward vis-a-vis the risk that I'd be undertaking, that justifies the position. This certainly lived up to it because a movement from around 8,000, 8,500 up to 17,600 vis-a-vis put a stop even all the way down below the lows, which would be 6,500, which is enormous stop if one would say by default that happened. Certainly gives you a reward to risk ratio. This is one of the values of looking at doing these projections.
Hank, thank you so much for coming in and sharing your expertise with us. Really, really great to hear you speak. Thank you very much.
You're so very welcome, Natalie. My pleasure.
Thank you. That's all we've got time for right now, but if you want more exclusive interviews with market insiders, then stay tuned to Dukascopy TV. Goodbye.